What's up, stock compounders? Brad here. So today I want to talk about Mohnish Pabrai's latest interview at Georgetown. This took place on March 4th of 2021. So just about a week ago. I love these talks, and they've been coming out a lot more frequently lately. It seems like every month we've had a Q&A session from Mohnish Pabrai at some university. So it's fantastic. I hope that keeps up. But in this video, I want to give my highlights, kind of my takeaways, the lessons that I really want to drill into my own head. So let's dive right into it. The first thing I want to talk about, so Mohnish talks about how the beautiful thing about investing is that all knowledge is cumulative, okay? You just keep getting better and better with age as long as you're continuously learning. And you know, he compared it to being an athlete, right, in the NBA. You're at your prime, maybe 27 years old. By the time you're 40, maybe a little later than 40, you're done. You're done with professional basketball. So there's a big edge for us investors who can kind of continue just to get better and better over the years. He talked about Nick Sleep and how he realized Nick Sleep's model. Nick Sleep was an investor in the UK from like the beginning 2000s up through 2013, I think. He realized Nick Sleep's model for investing was vastly superior to what Pabrai was doing. And I hadn't heard him say that before, vastly superior. So Pabrai decided, well, instead of buying these undervalued, these cheap, discounted pies, I'm going to focus on the growing pies, the long-term compounders. Okay, so that was that big shift. And the crux of the big shift is really looking at stock ownership like a founder, okay? Like you are in it for the long haul. That was kind of the big shift. He was asked, why are you doing so much investing overseas? And Pabrai said, well, he went overseas because he was finding it difficult to find compelling investments in the U.S. There's nothing magic about going overseas. He doesn't care about being an international man of mystery, okay? It was really just he wasn't finding anything in the U.S., so he had to look abroad. Japan, Korea, Turkey, some very cheap companies out there in those markets. In fact, those entire markets tend to be pretty cheap right now. And really, the thing that allowed him to go overseas into these countries that he doesn't have much experience in is he has these value investor friends in these countries, kind of worldwide. He has these great investor connections. And it's critical that those individuals, can take him on these tours of different businesses that fit their framework. It's usually a Benjamin Graham-based framework, cheap companies on, metrics that Graham liked to use. And Pabrai, he's kind of nudging them, trying to nudge them more towards, the Charlie Munger approach to buying the long-term compounders versus the dollar bill for 50 cents. So those international people who live in those countries who are great investors, it's really critical for Pabrai to be able to invest in those countries and just to learn as much as he needs to learn to feel comfortable with owning businesses in those countries. He was asked, what is your most interesting investment? He said, well, do you want the good or the bad, right? The biggest winners or the biggest losers? And the questioner said, well, you take your pick. And Pabrai said, the best lessons come from the losers, okay? We don't learn much from the winners. It's great. We make money on the winners. So, we obviously like those. But that's not where the greatest learnings come from. He says the biggest losses for him have come from companies with leverage, okay? He mentioned Delta Financial, which was a mortgage company, lost all of his investment on that, I believe, during the global financial crisis of 2008. So he's much more leery about debt now. He still has investments with debt, but this was an interesting point. He said the downside is ring-fenced, okay? So through whatever means, he's been able to figure out how to kind of minimize the damage that can be caused by that leverage in those businesses that he currently owns. So let's see. He was asked, how do you identify competitive advantages in businesses? Okay. He answered, if the business has a strong moat and strong advantages, you will see over a long period of time it's showing up in the revenue and the growth and the cash flows. Okay. So those moats, those advantages that certain businesses have, they show up in the numbers if you have a long enough history of numbers to look at. He talks about how MasterCard is a great business and it really shows up in the numbers. So I haven't looked too much at MasterCard. It's always seemed very frothy to me, but maybe it's worth a look just to kind of get a sense for what some of these great numbers look like. Moats will make themselves quite visible most of the time. Okay, it's not that hard to separate great businesses from those that are not so great. That's usually pretty obvious. The challenge is that most great businesses are priced as if they're great, right? The opportunity is in finding great businesses that are misunderstood by the market or facing temporary headwinds, leading to a cheap stock price. Okay, kind of a temporary cheap stock price. Misunderstood or facing temporary headwinds. He was asked about his, foundation, the Dakshana Foundation. And I hadn't heard him quite go into this in previous talks, so it was interesting. He says, a large inheritance is a disservice to future members of your gene pool. So he's kind of, saying, it may be a bad idea to give your kids a large inheritance. And he equated this to, say you're a world-class sprinter, okay? Now your kids, because you live this, life of a world-class sprinter where you've got, all the money you need, the motivation isn't quite there. It's the equivalent of the kids of a world-class sprinter kind of starting on the 40-yard line, okay? If you're starting on the 40-yard line, it's going to be hard to be driven enough to, really make a life, in some ways make a life that's worthwhile, I don't know what I'm trying to say here. What else did Pabrai say about that? Anyways, so he basically said by the mid-2000s, 2006 or so, he realized that, they were going to have way more money than they could spend, okay, the Pabrai family. So at that point, you got to make a decision. All right, what am I going to do with all this money that I don't need? So Pabrai decided it was fairly easy for him to decide the only choice was to give it back to society. And so he set up Dakshana Foundation. He really wanted something that could be measured, okay? Because a lot of charities, they're doing great things in the world, but it's hard to know how effective that giving is. With a business, there's that immediate feedback. If you're running a business and you're not earning money, that business is going to die, right? The money is the life of the business. With a charity, you've got money that's continuing to come in. So it's harder to see the feedback, to get the feedback about whether the mission of the charity is actually being achieved or not. So Pabrai was very smart in how he set up Dakshana with this very measurable feedback system in place. He was asked about price to earnings ratio, or, how do we identify businesses that might be good investments? He said price to earnings is an inadequate metric to help us very much. And I thought that was interesting because, for a long time, Pabrai had been running kind of the low PE screener in Value Line to try to find new investment opportunities. And, obviously that can still be useful as a starting point. But, it seems like over the years, Pabrai looks less and less at price to earnings as an indicator of, how great an investment, how worthy an investment is. It's really about what are the prospects of a business in the next 5 to 10 years. Okay, what are the prospects of the business? What revenues and cash flows will be generated over that period, over the next 5 to 10 years? That's really what we need to figure out as investors, okay? It's not about price to earnings today. It's about what is the business going to do over the next, handful, dozen years. He talks about Walmart. For a large portion of Walmart's early history, you could have paid 100 times earnings, right? Price to earnings of 100, and still hit a home run. So that's a great example of why price to earnings doesn't tell the whole story, right? Obviously, even though Walmart looked frothy on that metric back in the 70s and 80s, the prospects for the business were just incredible. So that's the more important thing there. Question: what advice would you give to someone who wants to start a fund? Now, this was a very interesting question to me. And the questioner also mentioned, 0, 6, 25 doesn't really seem feasible at the beginning. And obviously where this student was coming from is, if I'm going to start a fund, I still need to put food on the table, right? I need to make an income by managing this fund, okay? Now, Pabrai has a whole different take on it. And how Pabrai did it was, he had $1 million from a business that he sold back in 1995. He turned that $1 million into, I think, $13 million over the next 5 years, okay? So, Pabrai was already, you could say, independently wealthy by the time he started his fund. And he mentions what Charlie Munger would say is, if you're not already independently wealthy, why am I going to give you my money to invest, okay? Even if you start out with small sums as an investor, if you're able to significantly outperform the market, because of compounding, you're going to turn that small sum into a very sizable, basket, in a fairly short period of time. So, not exactly what the student wanted to hear, I'm sure, but it makes a lot of sense. And then he told the story of Li Lu, which I posted on my Twitter, I think yesterday. So Li Lu, Munger gave Li Lu money to manage because Li Lu came as a penniless student from China, studying at Columbia on student loans, right? Li Lu took out student loans to pay for his university education. There was a float between the time he got the loan and the time the tuition was paid, right? So he got the money from the student loans to pay the tuition, but there was a time between when he got the money and when he actually had to pay for the tuition. In that float period, he invested the money. That's a bold move. By the time he graduated, he had over $1 million just from the float of the student loans, okay? And, Li Lu talks a little bit about what he invested in college. One was American Tower. I just found out recently. I haven't really looked at that one yet. But I remember the example he gave of, finding an opportunity in Russia where I think, he was buying a dollar for like 1 cent. Okay, something insane like that. And that's a pretty interesting story. I think I've covered that in previous videos, but okay, we're coming down to the finish line here, everyone. So that's it. The first basic criteria that Charlie Munger would look for, one of the brightest investors of our time, is before giving someone money to manage, is the person financially independent? Okay. If you're right, I already covered this part. So if you don't have a track record, okay, so if you're not financially independent, you still want to start a fund. There are a lot of people in that situation. Focus on family, friends, and fools. And the fools are the most important, okay? So wise advice there from Mohnish Pabrai. How do you decide whether to invest in a company? You should be able to explain to a 9-year-old in about 5 sentences why you are going to be drowning in wealth after investing in that business and why there's no chance you could lose any money, okay? So clarity about the investment upside and the downside, the lack of downside. So I love that concise answer. When considering when to trim or sell a position, right? So he's asked, when do you trim? When do you sell out? How do you know when to sell one of your holdings? Pabrai really just has to ask one question. Is the business getting better? Okay. If the business is getting better, forget about the valuation. Throw the valuation out the window. Because, we're looking at these investments as founders, right? So it's our baby. It's our business. We're going to ride it as long as it's getting better. It's compounding our wealth. And we don't have to do anything. We just let the business do what it does. So I like that answer. He says we should be comfortable with 95% of the portfolio in one stock. Whew. Wow. If you made a great investment in Amazon, say you made it 10 to 15 years ago, and it just grew and grew, right? It's a massive chunk of your portfolio now. Is Amazon getting better today? Absolutely. Pabrai, without a doubt, Amazon is getting better today. So even if it's 95% of the portfolio, that's fine. We own a business. It's getting better and better over time. So we're done. We wait. We wait until the business is no longer getting better. So that's pretty straightforward. Charlie Munger would say, so he was asked about diversification. Charlie Munger would say you don't need more than 4 to 5 stocks if you're investing your own money, okay? And I really like that answer. That's about where I'm at. I like to have about a 20% position when I buy in to a company. That's what I did with Micron. It's what I did with Seritage Growth Properties. 10 positions is plenty if you're managing other people's money. And that's really what Pabrai does with Pabrai funds. 10% bets. So again, pretty straightforward. He thinks you don't need more than 10. Once you start getting more than 10, you getting into 20, getting into 30, you're really diluting your best ideas with ideas that you don't know as much about, right? Businesses that you don't understand as well, and don't have as good of prospects over the next 5 to 10 years. So that's probably a mistake. He also mentioned Li Lu and Nick Sleep both tend to start buying small. They don't seem to have an issue buying as it goes up in price, which is something I've been trying to get better about, not anchoring to that initial buy price. The reason they tend to start buying small, and the question here was really, how do you know when you know enough to make an investment, to buy into a company? And Pabrai is saying, well, there's some great investors who they nibble, right? They get in kind of slowly. They inch in. And Li Lu's kind of justification for that is the risk factors go down as you own the business for longer because you know more about it. You better understand the business once you're an owner in that business. And he says the increase in knowledge obviously can outweigh the increase in price. So I really like that framework because it's tempting. If something gets really cheap, right? You don't want it to go back up, and you don't want to miss out. But if you buy in a little bit and you learn more and more about the business, Li Lu's perspective is, well, it's okay if you buy as the price goes up, because your risk is actually going down. Because the risk is really not fully understanding the business, where your holes are in the business is where risk comes from. Because if you understand it, you understand what it's worth. And maybe it's okay if the price is going up because it's still worth more than that price. Obviously, all of this depends on the particular situation, but some interesting kind of frameworks, perspectives from Li Lu. So you really understand a business only after you own it. So, you don't necessarily need to wait too long. You don't have to understand 90% of the investment thesis necessarily before you start buying in. And I know I've done this before, like with Lithium Americas Corp. I took a small position, and I didn't know a whole lot about it. I had kind of read an investment write-up about it, a little bit on the annual report, but still a lot to learn about it. But I'm certainly more motivated to kind of get in there and understand the business now that I've got a little skin in the game. So, Pabrai doesn't really do that, though. It doesn't seem like he inches into positions. He kind of just goes head on learning about that business for a couple weeks, a couple months, depending on how familiar he is with that industry. And then it seems like he'll just plop down a 10% bet if the price is kind of in that sweet spot. So different strokes for different folks. So that is it, guys. I hope you enjoyed this kind of top takeaways, kind of highlights from Pabrai's latest interview, latest Q&A at Georgetown. It's so fun. I hope he keeps coming out with month after month, these talks at universities around the world. You can tell just watching him, even with just about the same questions from Q&A to Q&A. There's such a depth to Pabrai's knowledge and wisdom. It's great. I could just watch all day. So anyway, guys, hope you enjoyed this. Hope you got something out of it. I will see you all in the next video. Take care.